Hi, this is Alan Gassman. I hope you're having a fantastic Tuesday. I'm here with Jerry Hesch and Marty Shenkman. We're going to talk about the Biden two-step. We're going to talk about the Notre Dame Tax Institute, and we're going to talk about Marty Shenkman's thoughts on particular items that will be discussed at the Notre Dame Institute. So let me start here by giving you the sign-up information. If you want to know all about the Notre Dame Institute, if you want to sign up, and I hope you do, here you are on page 2. That's where you go. And why would this be important? It is vitally important because this, in my opinion, is the premier institute in the United States. And the reason is because of the depth and the practicality of the presentations that you see at the Notre Dame Institute. There is no other institute which commands the very best speakers to go an extra mile and adapt their presentation to what's practical and what's important under the guidance of Professor Jerry Hesch. Jerry, do you want to give us a little bit of background on what your philosophy is and what has made this institute such an important resource for the practitioners who have been fortunate enough to go to it?
Thank you, Alan. This comes out of my being a full-time law professor and realizing that it's not how much you know, but your ability to communicate it in an understandable manner. And in a lot of programs that we attend, the speakers are absolutely brilliant. They talk about these wonderful techniques, and they go through the code sections, the case law, the sophisticated legal analysis, and unfortunately, they're sometimes limited in time. So the first thing that we do is I give my speakers 60 minutes, and they're to use the extra 10 minutes to go over the basics that they're going to build upon for describing their technique. Secondly, one of the things I noticed is when you are trying to explain some of the planning techniques, we tend to use acronyms and code sections. And so what I have a lot of my speakers do is do a financial analysis of the various techniques. In other words, not just describe the technique and what it can do, but use simple to follow numerical examples so that you can see the financial impact of a technique. Because once you see the financial impact, it gives you the ability to actually translate it and explain it to your clients in an understandable manner. The second thing I try to do in Notre Dame is have very practical topics that aren't necessarily involving saving estate taxes. They're more practical things that you deal with on an everyday basis. Like last year, we had a topic, senior has a family business, very successful, senior has 4 children, wants to treat all the children equally. Unfortunately, seniors' children, not all of them work in the family business. How do you deal with a situation like that? A very practical topic. The other thing we try to do is talk about things that aren't generally talked about. For example, one of the topics that we will have is what happens when you have a charitable lead trust that you set up several years ago, and unfortunately the assets in the trust have tanked. And if you look at a financial analysis, you will see that the assets in the trust will be used to pay the annuity regardless of how long the settlor or the measuring life lives. And is there a way to bail out of that charitable lead trust? Because if you let it run its natural course, it will go bankrupt and there'll be nothing left for the remainder interest. And these are the kind of topics that are very practical, that come up, and you don't find them generally, and that's what we like to have at Notre Dame. just in general.
And you also require your speakers to have a full outline, not just a PowerPoint. And I know from experience that you read their papers and you send them back with comments.
No, Alan, he actually uses a red
edited
pen.
some of my speaker papers, yes.
He actually uses a red pen.
He does use a red pen and sends back the scan with the red markups. It's remarkable. Jerry,
let me just make a quick comment. The whole point of Notre Dame is practical planning, not just esoterica. It's not for the speakers to impress the audience with what they know, but for the speakers to really teach and train the audience. And that's what we're going to jump into in a few minutes and give you a very creative planning idea that will be useful for a large number of your clients in your practice right now in 2020 with the bizarre environment that we're in today. And following that, we're going to talk about just a number of different topics, kind of rapid fire, that are going to be on the Notre Dame agenda, just to give you a little appetizer, if you will, sort of a teaser of some of the practical information that'll be coming up.
Beautiful. Jerry, anything else you want to say before we go to our Biden two-step?
No, let's go to the substantive planning ideas.
Beautiful. All right. Well, we know that we are in a low interest environment and we have the applicable federal rates here for you. But regardless of whether we are in a low interest environment or not, we want to talk about the Biden two-step. It's really just a cute name. It doesn't have anything to do with Joseph Biden. What it has to do with is situating our clients so that if there is an imminent risk of the exemption coming down, the clients are ready to move in time. Because conceivably, I'm not saying probably, but I'm saying conceivably, you could be looking at a large reduction of the estate tax exemption as soon as January 1st, 2021. And when you have so many clients in the 30 to 40 to 50 and higher net worth range who have not used large parts of their exemption, who may come to you in November after the election, and let's face it, it may be 2 weeks after the election before we think we have results, asking, oh my gosh, how do I use this exemption? If there's come to you with a scattered group of assets, brokerage accounts, a general idea of what they want to do, no ability to really take nice discounts, that's going to be very challenging. It's going to actually be improbable that you can get this done before year end. On the other hand, if you've taken a close look at their situation well before November, and you've set up whatever family holding companies, whatever dynasty trusts and other planning you want to do, and you've gone ahead and made that initial aggregation of assets and sale in exchange for a note, then in November, you are meeting with them and deciding what to do with the note.
Let me just interject a couple of comments. There's a couple of really critical goals here, and I said a few minutes ago that this is something that will apply to a lot of your clients. First, clients don't like coming to us as estate planners. They do not enjoy the process. A number of years ago, I had a client that came to me, and she was writing notes on her yellow pad that tells you how long ago it was. 20 minutes into the meeting, she looked up at me with this pain look and said, you know, this is more unpleasant than going to the dentist. And I think that's kind of a view shared by a lot of clients. So they don't want to do this. Planning to move millions or tens of millions of dollars of exemption is also going to be costly. Clients would much rather use their money for almost anything than paying legal fees, maybe with the exception of Alan. People I hear like to pay Alan. But they don't want to do this. They don't enjoy the process. And even more significant now, and this is reminiscent of what happened in 2012, and this is at the heart of the planning idea that we're going to present. In 2012, lots of people did really stupid, and I know that's a strong word, but it's intentional planning at the last minute. And when I say stupid, a lot of times the planning was done without them really thinking about it. It was rushed so fast that no advisors could really advise them properly. And that led to a lot of the buyer's remorse at the end of the day because they were just uncomfortable with what they had done, especially when the exemption didn't go down. So we may face that now. People are hesitant because they don't want to go out and give away $10, $20 million, 11.58 times 2 potentially, and then find that the laws aren't going to change. There was no Democratic sweep, and why'd they go through it? So the Biden two-step, and I don't know if it was Alan or Jerry that came up with the dance name for this, but the Biden two-step helps you get the client teed up today, now, when it's practical and feasible to plan, but gives the client the benefit of hindsight so they don't have to have the buyer's remorse of 2012. So it's just a great plan that you may use. And even if you don't use it, this is a great idea to offer to almost any client that walks in your door now. Alan?
Yeah, it's snappy. And step one, of course, is to get your arms around the assets, the investments, the family plan, what they want to do, get those assets into a holding LLC or a family limited partnership if they're not there already. Let them sit there a month or two, value a non-voting member interest, seed capital, an irrevocable dynasty trust if you don't already have one. Think about decanting an old one into a new one if you want to use an old one. Get everything spruced up. And at the end of the first step, you have a large note back. It's a long-term note to the extent you are comfortable making it long-term. It's at the applicable federal rate. So now you've got a happy client. They have a lot of assets under a dynasty trust. They have a large note owed to them. If it's a Republican victory, they can reverse, they can sell, they can transfer the note back or cancel the note, get their assets back based upon the values at that time. They've got a nice dynasty trust with a seed capital gift. There's no harm done.
Alan, let's just make sure everyone's following. So in other words, if I have a $20 million estate and I could make an $11.58 million gift, I don't. I may put $1 million or $500,000 in a seed capital, but the rest is selling that discounted LLC or FLP interest to the trust. So at step one of the Biden two-step, I'm not making a gift to use most of my exemption. I'm selling an asset for a note to tee up the next step of the planning, should we want to do it.
Exactly. And then step two, if there is a Democratic sweep and or if the client is comfortable using a big part of their exemption, all they have to do is forgive the note or gift the note to another trust or a trust, or as we're going to talk about in a little while, gift the note to a Q-tip trust, and then they can decide next September whether they want it to be considered to be a gift to the Q-tip trust, like it would have been a complete gift. I use that in quotes, or whether they want to, in effect, get the note back, take the full marital deduction, and not have it treated as a complete gift. So you have those flexibilities. I've given you a chart here on page 14 to help you explain it to the client. This is a little bit oversimplified, but at the top you've got John Smith. John Smith has a revocable living trust. You put John Smith's investment assets into John Smith Holdings LLC. You put a seed capital gift into the irrevocable trust for the spouse and descendants. It's a SLAT, a spousal limited access trust. You wait the proper period of time. Then he sells the 99% non-voting member interest for a 20-year, 1.12% interest-only note. Now, once the client buys into this, I go to slide 15. Now, for Mrs. Smith, we do the same thing, only the trust that she transfers to and makes the gift to is not a SLAT. It's just for the descendants. But it might be in Nevada or another asset protection jurisdiction where she might be added as a beneficiary if terrible things happen and she would become financially destitute.
And And just to interject, you could do it as a slat. And I think the reason Alan was making it a non-slat and just for descendants was because he wanted to break the reciprocal trust doctrine. Not for our webinar today, but there's lots of other ways to break the reciprocal trust doctrine. And you could have two non-reciprocal slats with lots of differences built in. And you could have, like Alan suggested, a hybrid DAPT. I don't think he used the buzzword, but just so everyone's clear, where somebody like Jerry Hesch in a non-fiduciary capacity could add Jane back as a beneficiary.
If certain circumstances were to exist.
Right.
Now, we do want to remind you that under Section 2036A2, if the grantor or a fiduciary acting for the grantor has the power, in conjunction with anyone, to determine if and when the assets being sold may be distributed, then you could have an issue if the funding of the entity was not a bona fide sale for good and valuable consideration. We're not going to spend the 40 minutes that it takes to actually explain this, but what I offer the clients here on page 17 is an additional component. This is the same chart I just showed you, but there's a new player on the top right. It's an irrevocable trust. It might be for grandchildren or charity. The trustee of this trust is not a fiduciary for the client under his power of attorney or under his revocable trust. This trust is for something a little bit different than the dynasty trust. It simply owns 0.1% as a special voting member, but it controls if and when there will be a liquidation or distribution from the entity, and the client can replace the trustee of this trust with another unrelated party as long as they are not otherwise acting for the client as a fiduciary. And then, yes.
Alan, what about just setting up a simple homestay trust, especially if you did the slat in a trust-friendly jurisdiction, one of the DAPT jurisdictions, and just give away the 1% so the client has nothing left?
That would be fine. Most of my clients want to control the day-to-day decisions of the operating entity, but if you've got a client that doesn't want that control, that's fine if you give the control away. It's a very good thinking.
But that's where you start to get the sticky wicket that you want to mention to your clients. The more control they retain, the more risk they have, and it's really their judgment call where on that continuum they want to be.
Right. And then I throw in one other thing if they want it. Now, let me mention, I start off simple. The first chart you saw, I get the client to say, yes, I'll do it. Then I say, if I make it a little bit more complicated and I add this blue trust, it's a little bit better. Is that okay? Yeah, that's okay. Now I add one more LLC. I'm concerned that the client will get in a car accident or get a new girlfriend and lose the note. So can I put the note in an LLC owned 99% by the client and 1% by the daughter with equal voting rights so that the daughter has the ability to protect that note? Just another idea of where you could end up. Now, incidentally, that note might be discounted. Jerry's going to talk about that. But this schematic right here on page 19 is a client pleaser. So please use it. So we have completed step number 1 with this arrangement. So, by the way, there's a lot of reasons for this. It's not just estate tax avoidance. You know, to avoid Section 2036A2, you want to have bona fide reasons for things you're doing. This arrangement allows multiple generations to have involvement with identification management of assets. It allows assets to be shielded from undue influence and lack of management. Quite frankly, it allows CPAs and lawyers to have more involvement with the family to make sure that the elderly client is not going to be taken advantage of or be overly careless. It's providing creditor protection, and it's allowing the children to become more adept at working with each other because clients prefer that the children will stick together after they die as opposed to just going their own separate way.
Quick comment. So in the current environment, the asset protection benefits that Alan mentioned very quickly really deserve highlighting for clients. Number one, we have no idea what kind of litigation may come out of COVID. You know, do you have a business? Are people going back to your business? What kind of liability exposure do you have? You have a pool in your backyard. You have the neighbors over. Somebody gets COVID. We don't know the liability claims that may come out of COVID, and there could be substantial. Second, I'm not sure, but I think we're still in a recession. You know, it seems, depending on whose article I read, you know, we're you know, in the V or we're in the W or whatever. But when there's economic downturns, and I do believe we're struggling, and I think we're going to continue to struggle for a while. Economic downturns always breed more litigation. It's just how it is. So this is an opportune time for clients that have not done asset protection planning in the past to do it because of the heightened risk. Another point, if the Democrats sweep, and we're not projecting or predicting anything, we're trying to give you clever planning regardless of what happens, which is what the Biden two-step plan is. But if the Democrats sweep, consider not just the estate tax implication, but the asset protection implication. The Democratic proposals in the Obama administration, Hillary's proposals, President Obama's Green Book, the Sanders tax proposal in the Senate, Gomez in the House, all provided for a $1 million gift exemption. Think of what that does to the asset protection planning that, with Alan's schematics and the approach we're presenting, could be so easily done now. So asset protection is really should be high on the list. Alan?
Jerry, have you found that valuation experts are willing to give an additional discount for the fact that we are in a virus and that a lot of things are not being bought and sold? And what kind of discounts are you recommending that people take when they have a choice?
From a practical point of view, a lot of businesses are affected by this in the short run, and there's an expectation that their short run profits will go down, but that they'll rebound in the future. And just the general expectations on the economy and everything, despite the stock market, which nobody can explain. For closely held businesses, there's probably a little bit extra valuation discount. But the point that I try to make is there are three factors that actually attribute to wealth depletion. The first factor, which everybody discusses ad nauseum, is being able to discount the value of an asset for lack of control and lack of marketability. That's a one-time structure. The second factor is what we call financial leverage. When we do grants, or a grant is nothing more than a sale of an asset to a grantor trust for an annuity at the 75/20 rate. An installment sale is nothing more than a sale at the AFR. And if I can invest, if the purchaser in the GRAT or the purchaser in the installment sale is able to reinvest the asset at a rate of return greater than the interest rate on the GRAT or the interest rate on the note, that lasts for the lifetime of the deferred payment obligation. For example, if you do a 20-year installment sale at 1.12%, which you can do today, what do you think market rates and the AFR will be 5-10 years from now? We hope it'll rebound. And if I can lock in borrowing money at 1.12% today for the next 20 years and be able to reinvest it at a greater rate of return, true, today I might not be able to reinvest it for much in excess of 1.12%, but I can guarantee you when things return to normal, I don't know when, that market rates and everything will be much greater. So more importantly than the discount, which is a one-time upfront factor, is the financial leverage. But that isn't even as important as the fact that it's a grantor trust. And every year in the grantor trust, the grantor has to report the trust income and pay the income tax on it. And as assets build up in that trust, the income tax costs will be significant. And if you run a financial projection out 20 years, you will see that the size of the discount is the least significant factor, that the financial leverage is more significant, and that the grantor paying the income taxes on the trust income can be so large that it might even deplete all of the senior generation's asset after 15 or 20 years. So doing a financial projection of all three factors is very important, because you have to show that you have to custom design it financially to accommodate what you anticipate will happen in the future. So I'm not that concerned with the size of the discount, because that only applies in the long run, in the short run, and in the long run, it's not that significant of a factor. So, and I tell my clients, you take an aggressive discount and you're sure to get audited. You take a discount in the lower range that the IRS is willing to accept, your audit probability goes significantly down.
Let me just add a quick point on that. In the COVID environment, there's a number of different issues that may factor into the valuation. As Jerry said, it's not just the discount. One of the things that may discount the value is the estimation of future cash flows. So it's not just the discount for lack of control and marketability, but if you have a restaurant business, a real estate business, the way the appraiser estimates future cash flows for purposes of the analysis may be quite different today than it was in January pre-COVID.
Well, that's part of the real valuation.
Yeah. And we don't mean to say anything real. We're just tax guys.
Right.
Right. So, Jerry, I've got a chart here that I thought was very interesting. I read the article that you published in Bloomberg Tax, and it was a really long, detailed article. You and your co-author must have just done a lot of work on this. And I even made a chart. I had one of my law clerks make a chart from the article. I have to be honest, I realized that you could make a sale for a low interest bearing note, but I didn't realize that when you go to value that note, it's not worth the face value. Can you give us a little bit of background on that and on the planning opportunities that this offers?
Yeah. What people don't realize is, once you get back a note, the note in and of itself is an asset. And if you look at the case laws, there's a whole slew of cases. Some of them are income tax cases, but they all went to how do you value a promissory note that was either gifted at a later point in time or included in the gross estate. And what you see is that based on these cases, there are a whole slew of factors where the courts have said the note isn't worth its stated principal amount. It's worth less because of certain fluctuations in interest rates over time, the length of the note, the quality of the business that's the collateral for the note. And if you look at all these factors, you'll see, my God, look at what they're doing here. Look at all the promise. Look at the court's results in these situations. And it's just amazing when you go through a lot of these cases where the note itself can be, if you're going to include it in the gross estate or you're going to gift it, the note itself can have a value less than its stated principal amount.
Jerry, can I ask the question that's on everybody's mind that's watching this? So I do a note sale in November 2020, and I sell a $20 million business interest or family LLC interest for a note to a trust.
Why don't you use the figures on the slide?
Okay, and so if I sell this LLC interest worth $10 million for a note, if next year I want to get rid of the note or do something else with the note, isn't the discounting of the note somehow contradicting the sale that I did? And I know you had some interesting answers on that, but I'm sure that's on everybody's mind. Like, aren't you getting 2 bites at the apple, so to speak?
Well, actually, that is what the IRS has been arguing in a lot of cases, where they lend money to a trust, and then they turn around and take the note and discount it. And the IRS said, how can you value a promissory note at less than its stated principal amount? You must have intended that from day one. And therefore, if you have a 10 million sale and then if you gift the note a year later and value that at 9 million, the IRS will come back and say, well, you never expected to get 10 million, you only expected to get 9 million. And therefore, it's not a transfer for adequate consideration. Now, interestingly enough, this goes back to the gift on formation argument, where people put an asset into a family limited partnership. Let's suppose an individual puts an asset worth $13 million as their capital contribution in exchange for a membership or partnership interest in the entity. They get a 13 million capital account. And right away, the IRS says, but then you sold your limited partnership interest for 10 million. There must have been a gift on formation of 3 million. And the courts in 3 separate tax court cases over the last 2 or 3 years or 4 years have found it's not the value of the limited partnership interest, it's what rights you receive for your capital contribution. And in the partnership agreement, you didn't get a capital account of $10 million, you got a capital account of 13 million. Therefore, under the partnership agreement, you're deemed to get you're going to get the income, you're going to get a partnership interest based on 13 million. You're going to get income allocated to you based on the 13 million. And if the partnership liquidates, you're going to have a right to be redeemed for your 13 million capital account. So the principle applied in those partnership cases also applies here. It's not what you can dispose of the note for, it's what you receive for your 10 million loan. And what you receive for your 10 million loan was adequate stated interest on the 10 million and the right to receive 10 million in the future. Therefore, you can't have made a gift on formation, like the IRS has argued, and they've lost it in the partnership area, but that principle, it's what you are receiving in return. And if you're receiving in return a right to adequate stated interest on your loan and a right to be paid the 10 million on maturity of the loan, that note, when it was issued, is deemed to be for adequate and full consideration and money's worth. And you have a statute, section 7872, that basically says if you do a loan and you charge adequate stated interest, there's no gift. Well, if there's no gift, it must have been worth the $10 million.
By the way, the proof that you're right is I guarantee you anybody that was thinking the question that I just asked you, which was a setup because I knew I had to ask it, I don't think any of those people, when Alan went through his schematics and suggested the contributions to the LLC, even if there was another partner, and in some of them there were, nobody had questions about that triggering a problem.
Yeah.
But they do on the note because it's just a different application of the same concepts.
Yeah. Now here's something very interesting. There was no gift on when you make the loan, but how can I value a $10 million loan at 1.12% interest, say for 20 years? Suppose 5 years from now, I want to make a gift of that loan. What do you think the applicable federal rate will be 5 years from now?
I hope a lot more than 1.12%.
It'll be higher.
Better be.
So here's
Otherwise,
the key.
we're in real trouble.
I have a long-term note that's paying 1.12% AFR interest. 5 years later, I want to make a gift of that note, and the AFR is 5%. That is automatically, and the code section 1274 and 7872 both say you value the note by using the current AFR as the discount rate. So what you have done here in this situation is if market rates, if the AFR goes up, you automatically have created a market discount, just if the AFR goes up. Now, what's also interesting is if you look at the legislative history behind Section 1274 and 7872, you will see that the AFR is based on Treasury bills, and it's not a market rate. So essentially, there's nothing in the Internal Revenue Code that prevents you from using market rates. So if market rates are 2%, and I issue a 1.12% AFR loan, and I want to turn around and immediately dispose of it, but market rates are higher than the AFR, I can do so because the statute doesn't restrict you to using the AFR. Now, the Treasury Department recognized this shortly after Section 7872 was enacted in 1984, and they issued a proposed regulation in 1985 saying, we recognize that I can discount an AFR note just by using market rates. Therefore, in the proposed regulation, they wanted to say, if you're going to value the note for later disposition, you can't use market rates, you got to use the AFR. So the Treasury Department recognized the flaw, not a flaw, but recognized the disconnect, but that is a proposed regulation which has never been adopted, so it's just proposed, and proposed regulations have no force and effect. Now, there's a lot of other, but what I'm saying is, you can just tell the client, you can hold the darn note for 5 years, and the AFR will be greater, and the IRS will compute the discount for you, because they're required to do that by the statute. Now, if you look at the cases, there's all sorts of other factors besides market rates and interest rates. The length of the note. The longer the length of the note, the more risks there are, and that's quantitative. And there's other factors. The quality of the property. If it's a volatile asset, it could be a problem. And so what a lot of those cases do is look at other factors as well. So the bottom line is, if you want to turn around and dispose of that promissory note, the statute doesn't provide for gift on formation. And therefore, if you want to take a valuation discount based on a number of factors, you're entitled to do so. Okay.
Jerry, let's go to number 3 here on this slide. There was a private letter ruling in the 1990s which said that a note issued to the grantor of a trust who sold assets to the trust for the note would be included in her estate because the note had a much longer period to run than her life expectancy. And go ahead.
It was a technical advice memorandum.
Okay.
And what happened was, mother and daughter were going to jointly purchase a asset, a vacation home, and the mother was going to provide 40% of the purchase price, and the daughter was going to provide 60% of the purchase price. So right away, 60-40, whatever the assets were, the daughter didn't have the money to pay her 60% of the purchase price. So the daughter borrowed $300,000 from the mother and used the $300,000 to satisfy the daughter's contribution to the purchase of the jointly owned property. It turned out the length of the note, it was interest only with all principal due at maturity in X number of years. It turned out the mother was very old, I think in her 80s at the time, and the tax court by the way, the mother died 2 years later, and left the bequest of the note to her daughter. So the tax court basically said, wait a minute, when the mother lent the money, there was no expectation that the loan would ever be repaid because, number one, the term of the note was far beyond the mother's life expectancy. Therefore, they disregarded it and said it's really the mother who provided the consideration, and the mother then canceled, and the mother left everything to the daughter in her will by canceling the note. So essentially, because the note was far beyond the mother's life expectancy, the tax court said the mother really provided the consideration for the property, and then the whole thing was included in the mother's gross estate.
So, Jerry, if I'm doing this correctly and I have an 80-year-old client of reasonable health, how long would you set the note? It's certainly safe to set it for her life expectancy, but going beyond that, you have greater discounts. So where are you coming in on that?
You can't have everything, but you have to remember that lending money at 1.12% is, it's really below market. And I usually caution out of the clients, I wouldn't have the note be greater than the lender's life expectancy. By the way, there's no statute or regulation on this. This is just common sense, facts, and circumstances. There's a number of cases where the IRS has argued that when you sell an asset to a trust and take back an interest-only note, and you died while the note is outstanding, there's a number of cases that said have argued it's a trust substitute, and we're going to disregard the debt and treat it as a transfer in trust with a retained right to an annuity. The IRS will always argue that. In most of the cases, if the sale was for adequate consideration, the courts have held for the taxpayer. But the key is that it's a grantor trust, and you still get the grantor paying the income taxes on it. But it's just. Wait, there is some guidance, though, in the income tax area. The debt versus equity issue arises in the income tax area a lot, especially when shareholders don't want to make a capital contribution because the C corporation is subject to double tax. So the shareholders fund the corporation with $1, and then they lend $9 million to the corporation on a note. And in those cases, the IRS in the Section 382 regulations has basically said that we are going to disregard loans and treat it as equity if the shareholder loans to corporations are greater than 20 years. So I feel comfortable with 20 years because in the debt versus equity area, in the income tax area, 20 years has been a kind of safe harbor.
So again, if I have an 80-year-old client, maybe a 10-year life expectancy, I'm really safe with a 10-year note, but I'm fairly safe with a 20-year note, but not so safe with a 25-year note. I'm trying to figure out where the meter is.
Subjective. So the point is that that's one factor to look at. I call it reality of sale. Like if the trust has sufficient assets to always pay the interest and principal on the note in a timely manner as these obligations become due, you've established it's a transfer for adequate and full consideration.
There's another spin that you may want to consider. people that are doing this planning are wealthy or they wouldn't be doing the planning. And there's a very strong correlation between wealth and longevity. If memory serves me correctly, if you have a client in their 80s, you may find that a client in their 80s, in the upper
You're
1/5
absolutely right,
quartile,
Mark.
may outlive by 8 years somebody in the bottom 1/5 quartile of wealth. So one of the things that I've done in some instances is had an actual life expectancy calculation from the insurance settlement market. There's a pretty robust industry that can do that. And for like $500 or $1,000, you can get a report that will estimate actual life expectancy based on a review of the client's actual records. And that may show a life expectancy substantially beyond the tables. There's even a fairly inexpensive computer program you can buy called Halo, H-A-L-O, which you can input information into it, and it'll give you estimates of long-term care costs, nursing home costs, life expectancy, and so on. I mean, it's a bit crude, perhaps, but it's certainly something to show that you've made an effort to estimate actual life expectancy, and it'll even show you table life expectancy on a chart and the actual life expectancy above it in the differential.
Well,
Wow.
actually, what's very interesting, the Section 7520 tables use the 2000 census data. And there's three things with the life expectancy in those tables for someone age 70 is 14 years. What that means is there's a 50% probability that they'll still be alive 14 years from now. Those tables are also based on the US population as a whole in the year 2000. So that means that our clients are far healthier than the US population as a whole. And the third factor is that the tables are now 20 years old. So the true life expectancy for someone age 70 is no longer 14 years, it's more like 24 years. And when I'm talking about life expectancies, I'm talking about real life expectancy, not the artificial life expectancy in 20-year-old mortality tables.
Yeah. Yeah. And those tables include smokers in the general population as well. So
that's right.
Very good. All right. Let me see what I have next here. Jerry, we recently, as you know, published this Biden two-step paper. And we got a couple of emails saying that we really didn't warn the readers about what happens when the grantor dies with a note owed to them. Do you want to discuss that?
Well, let me go through it rather quickly. There's a few commentators who don't really understand income tax concepts that say when the grantor dies with the promissory note outstanding, the gain is immediately recognized, because remember, when the grantor dies and the note is outstanding, the debt obligation comes into existence for federal income tax purposes when the trust converts from a grantor to a non-grantor trust. Okay? The commentators who have taken this view don't really have any authority for it. They're just kind of shooting from the hip, and they fail to take into account there's a fundamental principle of income tax that death is not an income tax realization event. So that view is absolutely flawed. And the minority of commentators who have taken that view, if you look closely at what they cite as authority, it really doesn't stand for what they're talking about. So clearly, death cannot be an income tax realization event. So here's the key: we have a choice, okay? And the choice is, well, the first thing is you have the promissory note included in the gross estate, and the promissory note has to take an income tax basis equal to the value of the promissory note included in the gross estate. Now, these commentators sometimes say, It's income in respect of a decedent. But income in respect of a decedent is defined in the statute as income realized while the individual was alive, but not reported by the individual while they're alive because of their method of accounting. So you have to have a gain that is realized while the decedent grantor was alive. When you have an installment sale to a grantor trust, there's no income tax sale because for grantor trust purposes, the grantor is deemed to own the trust assets for federal income tax purposes. Therefore, no gain can be realized. So consequently, the promissory note will take a basis equal to whatever value it is valued at in the gross estate, period. Okay, so the remaining question is, and this is the unresolved question, and there is no statutory authority, regulation authority, private or public revenue ruling authority, and no case that has decided what basis the trust takes in the property. Now, if you look at Code Section 1015, which you reproduced there, it says, if property is acquired by a transfer in trust, the basis shall be the same as it would be in the hands of the grantor. Okay. Now, interesting here is Section 1015 was only intended to apply to gifts. And so if you read 1015 by looking at the principles, a sale to a grantor trust is not a gift. So 1015 should not apply. Okay. So basic, however, there are several articles that have come out with the position 1015 applies because they're reading 1015 literally and going beyond the context of when it was enacted in 1921. Okay. The other view is that upon the conversion to a grantor trust, the sale comes into existence. And since death is not an income tax realization event, based on general principles, the trust is deemed to have acquired the asset by purchase. So the other view is that the trust takes a cost basis in the asset equal to the amount of the note outstanding at the time the trust becomes a non-grantor trust. But at a minimum, no gain is recognized. So really, the only open question is, does the trust take the grantor's basis because we literally apply 1015, or does the trust take a cost basis because we apply fundamental income tax principles that when you acquire property subject to a debt, you get a basis for the amount of the debt? It's an open question, has yet to be resolved, and there's papers either way on it. But the IRS has yet to take a position on this.
All right, on page 32, I have a chart here, and let's face it, a lot of clients are reluctant to have full-blown appraisals of businesses, full-blown appraisals of real estate, and they're just not going to do this planning if you force them to get those appraisals. So with the Biden two-step, the first thing, the seed capital gift to the irrevocable trust, that can be cash. That will have to be reported on a gift tax return. No appraisal needed. Secondly, the funding of the family LLC with underlying assets, no appraisal needed. That's not a gift. Third, the sale for the note. If that is an arm's length sale, it does not have to be disclosed on a gift tax return. An appraisal should certainly be recommended, but if you have a client who says, look, I own 20 pieces of real estate just like this, I am an authority in this area, I know what they're worth, there's no way I'm going to pay $100,000 to get them appraised. Either I do this deal on my own knowledge or I pay my broker friend $1,000 per property for a broker letter of opinion, or I don't do this at all. Let's face it. You use the broker letter of opinion, you do the deal, you get the note back. Next year, when the gift tax return is due, you go back to the client. Are you sure you don't want to get appraisals? I recommend that you do. The client says they don't want to get appraisals. Do you want to disclose this on the gift tax return? Or do you only want to disclose the seed capital gift? That is their choice. Number 4, go ahead, Marty.
Well, there's different views of everything in life. With the amount of wealth being transferred in the transactions we're talking about, there's really, in my view, no reason or excuse not to get an appraisal. And there's multiple different types of appraisals. If you have 10 properties that are very similar, you may very well be able to get an appraiser to appraise one of them and use that as the foundation for the other and put the limiting conditions in the appraisal report. And if it doesn't conform with USPAP, the appraisal standards, they could so say. We've had lots of sophisticated clients that have generated a lot of the information internally. We have real estate clients with 50 and 100 properties that face the very issue you talked about, and they can generate internally a pretty comprehensive comparative market analysis or cost analysis of what a building's worth, and then just pay the appraiser for the discount valuation of, say, the parent LLC that owns the various building LLCs. So there's ways you can economize, but I'd be concerned of not having something that's plausible, because how do you defend it? And in terms of not reporting a sale on the gift tax return in general, not always, but in general, I'd encourage practitioners to have the client report it, told the statute of limitations, put all the information on the gift tax return to meet your adequate disclosure requirements. And I know there's differences of opinion and different views. All I do is caution practitioners to be understanding that if something does not work out, they need to be cognizant of what might be said. And if you're going to do a shortcut, I think you should put in writing what you've told the client. So
I think
the
that's
clients, yeah.
Very good advice. Now, Jerry, when I gift the note by canceling it, if it's a low rate note, if it's a $10 million note and I just forgive it, I guess I could put that on the gift tax return as a $10 million gift and not have to appraise the note. But if I go get an appraisal of the note and it turns out the note is only worth $9 million, I only use $9 million of the exemption. Maybe I gift some other assets in addition to that. I attach that appraisal to the gift tax return. Am I going to get challenged on audit? What is this process like? How expensive is it to get a promissory note appraised? What are your thoughts?
Well, there's a number of appraisal companies that I'm familiar with that actually have specialized in valuing promissory notes. And of course, if they've done it before, they're much more efficient. A lot of appraisers say, "Oh yeah, I'll just go in, look up all that, I'll read the stuff on it and input it." But the key is the IRS, when they look at discounts, they basically are willing to concede something. Like if you take a 40, 45, or 50% discount, the IRS is going to look at that closely. If you take a 20% discount, they might look at it in the office and say, 20%, that's what we would have offered in settlement. So, but the key is, if you get a legitimate appraisal, those long-term notes can give rise to significant discounts. And the most important point is, I can lock in today 1.12% for 20 to 25 years or more. And I can wait until the AFR goes up, and there automatically will be a significant discount that the IRS will compute for you. So the key is, the long-term notes are a second level of discount, and you can dispose of them. Now, one little word of caution. Let's suppose that we have a $10 million promissory note, long-term note, and if I dispose of it by gift, what basis does the donee take in the note? Carryover basis, correct? So if I lend $10 million to a trust and I take back a 10 million note, I got a 10 million basis. Let's say I lend a $10 million asset. Okay. But what happens if I include that note in my gross estate? And if I include it in my estate, there's no carryover basis. And I discount the note to $7 million. What basis does my successor and interest take in that note valued in the gross estate at $7 million? Alan?
I don't know.
$7 million, right? Fair market value at date of death. And the IRS accepts the $7 million. So now the beneficiary has a $10 million promissory note with a basis of $7 million. How do we treat the $3 million spread?
That's going to be income when the note's paid, I guess.
Right. It's a market discount debt obligation, and it's in Code Section 1276 that treats the market discount as additional interest.
Wow. Interesting. Okay, let me just tell you some more resources we have here. You can use these slides. This explains to a client both spouses, the slat, the descendants trust, the trust that would own the 0.1% special partner interest. This then handles the installment sale, again, just as an explanation. Also here you have slides that simplify the installment sale. You can show this to the client. It does not talk about the special general partner interest, but we take these step by step just to explain to the client how these work. You're welcome to use these slides. The last thing I want to talk about before we go to Marty's segment is to simply say that when it's time to forgive part of a large note or to gift part of the large note in the second step, you could transfer part of the note using a windrow clause saying, I hereby transfer a portion of this note equal to a value of whatever is left of my exemption. Based upon a fraction, the numerator is the amount left of my exemption, whatever that might be. If I ever get audited for estate and gift tax purposes, the denominator of which is the entire note. Put that on the gift tax return. You've got something to fall back on if the IRS challenges your discount. You could even leave yourself some room and say the numerator is $1 million less than whatever's left of my exemption. Or even a safer situation, you can use a lifetime Q-tip trust. I set up a trust for my spouse. It's going to pay her all income. I put the note into that trust. The trustee can also give her principal. Then, as we said, I can wait until September 15th of next year if I make the proper election to decide if I want that whole Q-tip trust or a part of it to be the equivalent of a credit shelter trust, except it'll have a little bit of leak in it because it will pay her interest unless she disclaims that leak. So this is a very, very good technique and opportunity. We're not going to spend time on it. We've given you the excerpt from our paper on it. I've given you also references to other papers, but whether you're going to do the two-step or a one-step, the lifetime Q-tip trust, so they can, in essence, reverse that gift by September 15th of next year, really gives you the ability to use hindsight. Page 47, I've just given you a picture of an installment sale and a spreadsheet that we've developed with Jerry, where you show that client, here's where you are, here's the installment sale, here's where you're going to be if you die any of the following 20 years, taking into consideration your income, your tax bracket, your living expenses, whether you're going to pay the tax for this trust the entire time, to try to get the client to where they will not be estate taxable no matter when they die, perhaps using self-canceling installment notes.
Wait, Alan,
we'll be glad to send you the Excel spreadsheet so you can use this yourself for clients. Go ahead, Jerry.
There was one slide that showed the income taxes paid by the grantor and the trust income. Go back to it. It's right there on the left.
Yep.
There. See column J? And look at column J. The first year, the grantor is paying $690,000 of income taxes on the trust income. Look how much they're paying in year 20. $2,339,000. In other words, the grantor has, in addition to the discount and the financial leverage, has been able to shift. How much is the total over 20 years?
$44 million.
They've been able to shift $44 million to a grantor trust with no gift or generation or estate tax consequences. The most powerful wealth depletion factor, if you compound it over a long period of time, is the grantor paying the income taxes. And when you show the grantor, hey, you paid $690,000 the first year, but in year 20, you're paying $2,400,000, the grantor might say, I think enough is enough. But then you tell the grantor, oh, by the way, even after the note is paid, you're still paying the income taxes. So the grantor might say, I think the trust is going to have more money than me, and I want to toggle off grantor trust status. So what the grantor tells the trustee is, trustee, you know that power that created grantor trust status? Terminate it. And the trustee says no. Why would the trustee say no? Because under Restatement of Trust 3, Section 78, it is now clear in all states that the trustee has a duty of loyalty only to the beneficiaries. And there's been two recent cases, one in Wisconsin and another, I forgot where the grantor asked the trustee to toggle off grantor trust status. The trustee refused to do so. The grantor went to court, and the court said to the grantor, you're out of luck. The trustee has a duty of loyalty only to the beneficiaries. And if we toggle off grantor trust status, that's less money for the beneficiaries. Therefore, you can't order the trustee to do it. So therefore, what is extremely important is you show this illustration to the client, and you say to the client, you want to continue depleting your estate for the rest of your life? And the client says, So all you do is you put in the trust agreement that at a certain point in time, after the note is paid, the power automatically expires by operation of the trust agreement. In other words, the most important part is the communication of the financial impact of this estate planning technique and showing the client the financial impact of it all and how the wealth is actually shifted.
Jerry, what if I gave Alan, acting in a non-fiduciary capacity, the power to modify each of the rights that creates grantor trust status?
Technically, maybe it works. I haven't seen it challenged. The easiest way is to have it automatically expire. To give a third party.
I think you may want to think about having a third party in a non-fiduciary capacity hold the power, express powers to terminate a right to loan to the settlor for without adequate consideration, et cetera.
Technically, I think it works.
One sec. One of the things that we're facing is that if there is a Democratic sweep, which is why we're talking about this entire plan, one of the proposals in some of the one of the provisions in some of the Democratic proposals was to have all the assets of a grantor trust included back in the estate. So practitioners might want to think about including an overarching provision giving somebody in a non-fiduciary capacity the right to turn off grantor status, because just like we're trying to set up the planning with the clients in the on-deck circle so they could forgive a note or transfer a note and make a gift at the last minute, we may want to be able to turn off grantor trust status, if we see what Democratic legislation looks like. And depending on the effective date, that may be too late.
I hadn't thought of that. That's very good, Marty. Thank you.
Okay. Now, the final thing I just wanted to mention is I had 3 or 4 emails asking me, how can you put together a promissory note owed to a family member or an irrevocable trust when it may not be enforceable under state law because there's no consideration for it. Now, this is going to vary by state, from a state by state standpoint, but I found a very good article by Austin Bramwell that I have cited here for you, and also cases which basically indicate you may have to have a little bit of consideration given by the party that receives the promissory note, but it really only has to be a thimble full of consideration. It still could be a concern in some jurisdictions, so you're going to want to look at Austin's article, look at this 1891 case, Hamer v. Sigway, and decide how you're going to make sure that there is ample consideration under state law. So, Marty, lead us through your discussion of selected Notre Dame Tax and Estate Planning Institute topics.
So the purpose of the next few minutes, and I'm asking Jerry and Alan to interrupt me and comment at any point, is just to round out the discussion we had. Hopefully this will be all superfluous, because after hearing the creative planning of the Biden two-step, you will register to attend the Notre Dame Tax and Estate Planning Conference. If you still need more convincing, shame on you, but we're going to give you a few more tidbits. So let's go on to the next slide. So one of the topics that's going to be talked about is state income taxation of trusts. And honestly, state income taxation of trusts has not gotten enough attention or respect. And hopefully, in light of the Kastner case, which I believe was last year, we will find more attention being given to state income taxation. Now, one of the reasons it's also very important in the current environment to consider state income taxation of trusts is the states have been horribly impacted financially, fiscally, as a result of COVID. Revenues are down dramatically. Expenses dealing with COVID issues are up dramatically, and states are going to be very hungry for revenue. And I already saw something, and forgive me if the number's wrong, but I think it was California proposed hiking its maximum income tax rate from something like 13 to 16%. Which is just an incredible thought. But this is something many states may have to do. I saw even recently something about a wealth tax in California. So we all need to be more attuned for this. So accountants, when you're preparing income tax returns, Form 1041, take a look and see where you're preparing a state income tax return. Can we change it? Sometimes by, depending on state law, if you get rid of the fiduciaries, the trustee in the state, the high tax state, and move the situs of the trust to a new state with a new trustee in a no tax state, that may be all that's necessary. That may be able to be triggered by a mere resignation of the trustee. It may be a trust protector action. In some instances, you may have to decant the trust to change it. Certainly, planning trusts going forward, we need to think about whether we're going to do a non-grantor trust versus a grantor trust to avoid high state income taxation. We're going to talk, there will be more programs about that in the Institute. Let's go on to the next slide, Alan. So this is something, and I made a comment earlier when Alan mentioned the idea of clients giving you pushback on getting appraisals. The right answer in all instances is get a full-blown proper appraisal by an independent professional appraisal. And Alan's comments are spot on. Lots of clients, when they see the cost of the appraisal, are in shock and not very comfortable proceeding with it, and either negotiate with the appraisers or try to get, a small accounting firm that may not have the expertise for the unique asset to do it, or to just try to short circuit it in many ways. So my comment was, put in writing if the client's going to do that and you're going to let them do it, but certainly try to get something plausible and supportable that you can file as adequate disclosure on the gift tax return. Here on this slide 58 are just some of the steps. And by the way, the real key point right now, if you're not inundated with work, you will be. This is going to be a deluge of tidal wave of work, just like 2012 was. I think it's going to be worse. Make sure you don't shortcut and forget to get a signed engagement letter. Get a signed engagement letter. Any engagement letter signed is usually a huge step in the right direction. Having no signed engagement letter, what was the scope of the engagement? Did the client ever agree to pay your fees? You got to get that signed. Limit the scope of the engagement to what you're really doing. And I'll give you an example of something that I'm starting to see in my practice now. We're getting so busy with year-end tax work that I'm actually putting out in writing or in emails or both to clients, we cannot do non-tax work now. So if you want a will revocable trust plan done, we can't do it probably until early next year. So if you don't want to wait, because God forbid somebody dies, I don't want the kids coming after me, we can't do it. We're only going to do the tax planning. Whatever it is that you're limiting the scope of your engagement to, try to document that. Inform clients of risks. Every plan, every technique, every mechanism has risks. What Jerry pointed out with the dramatically different views of how different practitioners and commentators view the valuation of a note, the basis of a note if it's outstanding on death, and so on. There's a lot of different views of lots of the different techniques that we all use. The Wandry clause Alan mentioned, lots of different views, iris non-acquiesced. There's risks with everything. If you're billing a client 10, 20, 30, 50, $100,000 and the client's saving potentially 5 or 10 or $100 million, you should not be taking on the risk for the savings the client's going to have. I think it's important in the memos and cover letters to remind clients of some but not all the risks and say that you're advising them of some but not all the risks. It's impossible to document every single potential risk. Impossible. But you can certainly alert them to the fact there's risk. And in my view, like, really? You're going to move 10, 20, $50 million, $100 million, $1 billion out of your estate and not have any risk? It's not possible. It's not logical. Document it. Protect yourself. Inform the client of options. So we gave you this concept of a Biden two-step, and along the way on the LLC and the trust structure, Alan must have given you, I didn't really count them, but a half a dozen different variations. Show the client options. Let the client make the decision. Document that you showed options. Inform the clients in lots of different ways. I talked about for specific client matters, but there's generic ways you can inform clients. Do a webinar and make it available on your firm website. Send articles to all your clients. Put footers on bills. That's something we've done for a very long time. Not only do we do a lot of webinars and clients get emails of all of it, and we save the email that shows that we sent it out to our entire mailing list. Every bill that goes out of my office, there's cautionary footers on the bottom of the bill. And now that we've gone electronic with most of the billing, in the emails that go out, I put current planning concerns and information, and we save those in the client's file. And the footer on the bill, which is, it takes a minute to do, add a footer. If you don't plan soon, you may miss the opportunity to plan before the impact of the election. Whatever issues you want to apprise clients of, put them on the footer so everyone's known. Terms of the retainer agreement, your retainer agreement, engagement letter, whatever you call it, should also have the fact that there's risks associated with all planning. If there's an audit that's not included in your fee, there may be interest or penalties charged. That's a client's responsibility. Again, for the fees you're getting paid, you should not be the guarantor of what the result is. Consider giving clients checklists for post-signing follow-up on some of the planning. Let's go to the next slide.
Marty, by the way, the Lissy article that you wrote with Howard Zaritsky on avoiding risk of malpractice.
And Sandy Glazer.
I send that article to the clients with my letter saying, I can't tell you every risk, but you should read the attached article. And here's some of the risks. And if you want to know more of them, please let me know, and I'll give you more. But
anything like that is brilliant. And I think most practitioners kind of chicken out or cop out and say, golly gee, if I let my clients know all these things in writing, they get scared away and not do the planning. That's not the right attitude. You are doing hard work, good work, esoteric work in a very uncertain area with lots of risk. You got to apprise the clients of that. The clients are, I don't think I've had a single client ever turn away because I apprised them of the risks. And frankly, if a client turns away from you because you told them there's risk that 2 slats could be reciprocal or whatever risk you tell them, you don't want them as a client, because telling somebody the risks associated with it, if you ever go on bungee jumping, read the disclaimer you have to sign. Let's go on to the next slide, Alan. That's a great step, though. Secure Act, there's going to be a whole special program Wednesday evening that Alan's partner is giving on the Secure Act. I find every time I hear another program on the Secure Act, there's always more to learn. The depth and breadth and options are just incredible. But the key thing is most clients need to at least rethink their beneficiary designations post-Secure Act. I don't think most clients, I would suspect a much smaller percentage of clients really need to modify their planning because of the Secure Act. But I think most should at least understand what it's done, because the elimination of this stretch may have a profound impact on their planning. Certainly for a number of clients with large plans, it's very significant. So eligible designated beneficiaries can still get a life expectancy payout. In the past, many could, but now it's limited really to a spouse or to a disabled or chronically ill beneficiary, and the definitions of those are very restrictive. Alan, why don't you say in quickly what the Teapot Trust is, because that's a creative idea as well.
Yeah, the Teapot Trust enables you to segregate the IRA into a complex trust and to spray the income from that trust among the beneficiaries based upon need and based upon their tax brackets. So if you have a school teacher and a neurosurgeon as beneficiaries, you can spray that trust. You could wait till the 11th year, or you could spray that trust during the years to that school teacher. And then there's a separate trust, a balancing trust besides the Teapot Trust. And at the end of the 11th year, you can do a calculation of what you've paid to the school teacher and what the net after-tax impact of that has been. And then you can use the separate trust to even that up. It's very, very useful to do this. First of all, it keeps the kids together for 11 years. It keeps the smartest kid with the best business sense pretty much in charge of everyone's inheritance. It allows them to kind of see what each other is doing to provide a little bit of family unity. It delays the inheritance and the control of the inheritance for 11 years. So those who are foolish enough to have a problem have a second bite of the apple. And it keeps the advisors involved with the family for those 11 years. So it has been a popular concept.
And charitable remainder trust, CRUTs, charitable remainder uni trust, can provide some interesting options to sort of mimic a stretch of an IRA. And I assume the Wednesday evening program is going to talk about all these techniques. I think, how long is that program, Alan?
It's 2 hours, and all attendees will get the latest edition of our IRA and trust planning book, which is a Lineberg book.
Wow. Okay, guys, if you haven't been convinced to sign up, if you register soon, you're going to get 2 books for one. Let's go on to the next slide. We have a whole panel with some very bright people. Kim Kamen and Sandy Glazer and Sharon Lip from Trust and Estates is going to moderate it. And we're going to talk about a topic that I don't know that I've ever heard anyone talk about in any of the conferences I've ever given to: tangible property. You know, it is almost assumed it's so boring and it's so basic, there's nothing to talk about. Whoa, quite to the contrary. There are so many issues to address. It's not basic or simple. And frankly, some of the worst family fights that I've seen over my 35 plus years of practice have been fighting over tangible property. Sentimental issues, you can't put a dollar value on them. It's really emotional, can be very difficult. Collections raise issues. I find that the vast majority of clients that have valuable collectibles have not done an appropriate professional inventory. It's not that expensive. The benefits of it are huge. What about storage, shipping costs? I remember many, many years ago when I first started practicing, a real problem of a shipping cost provision in a will. And there was an expensive Steinway piano that had to get shipped from New York to California, and everybody was up in arms about the cost of shipping it. Insurance coverage, obviously not wanting to have a gap or an issue, and you probably need appraisals to get that done right. So we're going to have a whole panel, and there's a lot of interesting issues about some of the legal issues that come up with tangible property. Ivory, guns, raise all sorts of issues. So it should be a really informative topic. And like I said, and this is what Jerry said early on in our program, that Notre Dame tends to always pick not just current topics like what we talked about with planning for the 2020 election, but just really practical topics that often are just off radar in so many places. So this should be a great panel. I'm looking forward to participating, and will assuredly learn far more than I know now just by hearing the other speakers. Let's go on to the next slide.
Let me just mention here, you've got a really good practice enhancement opportunity because so many clients have collectibles and they don't even tell you about them because they think they're going to be sneaky and not report them. And you've got to let them know you can't be so naive. They're on your insurance policy. They're going to be subject to tax. You may want to put them into an LLC. There's just a lot of practice opportunities there and a lot of knowledge to be gained before you talk to clients about their tangibles.
So that's actually an interesting point too. For a lot of moderate wealth clients with the exemption so high, a lot of these issues were off radar. If we end up back to a $3.5 million exemption, a lot of people that could have gotten by the seat of their pants are going to get nailed. It's just going to be a mess because, as Alan said, most of these people at least do insure it, often underinsured because they haven't had it appraised and have no idea the real value, and that's an issue. But once it's on the fine arts floater on your homeowner's policy, the IRS knows to ask for that. This is not going under any radar if you're over the exemption. So the change in tax law, and I just didn't think of this until you said it now, could have profound impact on planning for tangibles. So let's go on to the next topic. So, technology has revolutionized our practices. And what's happened in the last 5 months with COVID is people that never thought they would touch a computer or do a web meeting, that's all they're doing. So this brings up all sorts of interesting ethical and other issues. Do you record a meeting? Do you not record a meeting? Make sure if you record anything that the client knows it's being recorded. I believe on many of the web consoles that do recording, and I think they all do, there's usually some kind of red light that indicates, as on this one now, the session's being recorded, so you can tell when it's being recorded. But make sure people know and consent to being recorded. One of the uses is actually fascinating. It's not about recording it so much for a permanent record, but if you have a complex meeting with somebody, and I had one some months ago where a client had some very complex religious restrictions on their planning that I didn't really understand, and it was a new religion that I didn't have a great deal of background on, and I asked their permission. I recorded the webinar. I had it transcribed, and by having that transcription, at literally no cost, it gave me an incredible set of notes that I could never have typed as fast on my own or written down notes nearly as comprehensively. And I constantly referred back to that transcription in trying to work out some planning components. I think it's going to change the dynamic. Think about it. Even if we go back to physical signings of documents, I think the fact that the lid is off the box in terms of electronic signing and notarization, hopefully the profession will evolve fast, and these temporary orders that exist in many but not all states to permit remote signing will become permanent, and we'll have more uniform legislation that'll be meaningful, not stuff that mimics signed wills, but really true electronic signing. And I believe COVID will accelerate towards that, but it changes the whole dynamic. So in the past, I would say the vast majority of all practitioners I've ever talked to have never on purpose recorded hired a videographer to record a will signing. And they haven't done it because the question then, if there's a lawsuit, is, Ms. Jones, how many will signings do you record? Oh, just this one. And why did you record this one? Oh, I was worried about her capacity. You've already perhaps lost the case from that line of the discussion already. But if we're doing will signings electronically on web meetings, it may become routine to record them, and it may change the whole dynamic of how that's done. So there's all sorts of interesting pitfalls, benefits, but just things we need to think about in terms of what technology is doing to our practices. Do we have another slide?
Yeah, I want to tell a 1-minute story here that I think a lot of people can use. I had a client who was under undue influence. He had a bad relationship with the person he was living with. In his early 80s, the doctor said he was completely competent. The client refused to go to a psychiatrist or a neurologist, came to see me, and I had an interruption. And I had to leave the room for an hour. So I had a young law clerk sit with him and ask him questions for an hour on video about his history, about his present situation, about anything he wanted to talk to. And I came back after an hour and I said to her, "How'd he do?" And she said, "He did fine. He is really smart. He knows all sorts of stuff. 8 to 9 minutes after anything we talked about, he had no recollection whatsoever about the 8 to 9 minutes. And he confuses his daughters with each other, and he thinks the daughter down the street lives in Montana. Now, the doctor couldn't come up with that, couldn't get him to a psychiatrist. All it took was a 1-hour video. He ate lunch with her during the video. So don't hesitate to do that, especially right now. Get your client on a video call just like this one. Talk to them for a period of time long enough so that you can see that they really have the competency. And then the video says it all. Once the girlfriend saw the video, she stopped hitting on him for the inheritance. She knew he had been had. Okay, here's your next video. Here's your next one, remote executions.
We've kind of just covered that. I mean, one of the things you have to be mindful of is, when we had in pre-COVID, not so long ago, 6 months ago, we would have clients in our office. We would interact with them. We would see who was in the room, control who was in the room, talk to them. If somebody drove them to the meeting, we could have them leave the room or leave the office, go get lunch, come back in 2 hours, we'll talk, and talk to the client. What do you do when you're doing this remotely? I mean, one of the concerns is who's hiding just out of video range. One of the concerns is, can you really get the same perception of somebody on a video call as you do when they're face to face with you? There's also no law that I'm aware of on this. I don't think we've ever had, video recorded, web recorded signings before. So especially with a vulnerable client, there's issues we have to be very mindful of. What we've done is, even though there's temporary measures that may permit signing documents remotely, is we've advised all clients to view that as a temporary measure, and when they're able to re-sign in person using the traditional means, they should do so. And my concern in general for all clients is we don't really have any law on what these temporary measures mean. We don't even know that some of these temporary measures were going to be enacted to really be viable. And with a vulnerable client, it's ever more of a concern. Do we have another slide, or I think we're done?
This is the last one. Well, we have the client come to our office in their car, and the secretaries stand outside and watch through the car window. And we have the full signing through the car window.
Yeah, we call that the drive-by signing.
The drive-by signing. And that works really, really well.
So we've given you a little bit of an appetizer. That's the article that talks about the Biden two-step, which is in the materials, and you'll have that. We've tried to take one topic in particular, which is really pertinent to planning in the current environment. Alan dubbed it the Biden two-step, but it's really a note sale followed by a gift or forgiveness of the note, and more creatively for some, a contribution of the note to a Q-tip trust that gives you until the gift tax return has to be filed to decide if it's a completed gift or not. Very creative planning idea. We've also talked to you about at least another half a dozen of the topics that will be presented on the Notre Dame Estate and Tax and Estate Planning Institute. Jerry, when is the Institute this year? Do you remember the dates?
It's October 29th and 30th, at the end of October.
So, we the three of us, Jerry is the master of ceremonies and the guru of the Institute. Alan is on the advisory board and been very active in the Institute. We certainly recommend it to you. We think there's going to be we know there's going to be a lot of very practical information. And if that's not enough to convince you, I can tell you that I'm personally going to attend all the programs and get all my credits this year, because for the first time in probably 20 or 30 years with COVID, I'm not going to some of the conferences that I normally go to, and I want to make sure I get all the credits that I need. So, I hope that's not the real reason to motivate you to attend. Hopefully the really insightful and practical planning ideas will. Alan?
Jerry? I think we've said it all and more. Jerry, I can't thank you enough for the tireless work that you put into making this program the amazing experience that it is.
All right. Thank you.
You're quite a talent, and you work the speakers like no one else on earth. You do a great job with it. So, as Steve Leinberg always says, we hope that we've given you something today that you can use to help others. Please spread the word about the Notre Dame Institute. Please email us any questions, comments, or suggestions. You've got our email addresses there. Send me the easy questions, send Jerry and Marty the hard questions. And thanks again for listening.